Welcome back to Alpha Recap. Thanks for joining us after the close. We've got a lot to unpack from today's breaking analyses. As always, if you have questions, you can reach us at stockalpha.ai and drop them in the Q&A. Ready to dive?
Absolutely. Markets closed with a clear theme today: divergence. There were winners and losers, and the winners weren't spread evenly across the market. They were highly concentrated.
Yeah, that tracks. So, what really stands out here is how a few names and a handful of niche funds drove the headlines. We saw semiconductor winners and laggards, 3 exchange-traded funds beating the S&P 500 so far in 2026, and some corporate filings that brought governance and reputational noise into the mix.
Right. And the other thing is the scale of dispersions. A decade-long semiconductor case study in today's coverage compared 2 identical $10,000 bets in 2 different semiconductor names back in 2016. One grew to roughly $100,000, and the other grew to about $1 million. That's the extreme illustration of company-specific execution mattering far more than broad sector exposure.
Wait, say that again? $10,000 to $1 million? Wow.
Yep, it's a dramatic example. One investor had roughly a $100,000 outcome. Another ended up with about $1 million, both starting from $10,000. It shows why saying, "I own semiconductors," means very different things depending on which companies you actually own.
Big move.
Exactly. And that theme showed up everywhere today. 3 exchange-traded funds have outpaced the S&P 500 in 2026, but their outperformance looks driven by concentrated niche exposures, not broad market replication. That's short-term outperformance with a trade-off: higher volatility and tracking risk.
Short reaction? Not great for passive purists.
Honestly, I was a bit surprised by the Netflix reaction. The company reported what analysts called strong results, but the stock slipped on the news. That's a good example of how leadership concentration can override good fundamentals, or at least how the market's tape interpreted it.
Not what anyone expected after a beat. It felt like the broader tape said, "You're not expanding the leadership set, so we'll take profits."
There are competing reads. One interpretation is rotation away from any name that doesn't feed the narrow leadership narrative. Another is simple profit-taking, or tactical reevaluation of guidance. The data supported both, so there's real tactical tension there.
Right. And a couple of notable specific moves. Royalty Pharma finished the day around $45.91 and has climbed about 31.5% over the past 6 months, while Evercore closed near $275.48 and had dropped about 18.5% over the same period.
Those two are instructive contrasts. Royalty Pharma's rally shows how certain models, royalty or asset-backed biotech exposure, can decouple from the broad market when deal activity or pipeline catalysts happen. Evercore is very sensitive to investment banking cycles and deal flow, so the negative 6-month move reflects an earnings and deal backdrop that got tougher.
Also in semiconductor news, Broadcom announced that a post-quantum safe, end-to-end in-flight network encryption solution shipped on March 19, 2026, and they noted about 120,000 secure HBA deployments in the field. That's product traction in a high-value, regulated vertical.
Let's pause on that. Post-quantum cryptography, PQC, is about protecting communications against future quantum computing attacks. Broadcom's claim of a full in-flight, post-quantum safe encryption stack, plus substantial deployments, signals enterprise traction. Analysts noted getting early certifications and field deployments in aerospace can meaningfully expand addressable market and pricing power.
And then equipment suppliers like Lam Research got called out as beneficiaries of rising chip complexity. The narrative was simple. As process nodes advance, chip designs get more complex, and wafer fab equipment demand can rise. But, Juniper, there's still debate there, right?
Yes, some analysts present a bullish case for equipment suppliers because rising complexity is a structural tailwind. Others caution that foundry cycles, capital intensity, and inventory swings can create near-term revenue volatility. So you have a structural argument with tactical noise.
So many layers. We also had a few operational and governance items that mattered today. There was a PayPal platform anecdote that raised reputational risk questions, and 8K filings from Terns Pharmaceuticals, and a brand engagement network that signaled material agreements and management shifts. Small scale, but important for the names involved.
Exactly. These aren't market-wide drivers, but for affected equities, they can create outsized moves. Event-driven volatility matters more in a concentrated regime because a single name can move a portfolio if it's large enough.
Short reaction? Watch the event windows.
Let's step back and summarize the main themes and what analysts agreed and disagreed on. Agreement. Leadership concentration is measurable and real. Analysts also largely agree semiconductor complexity helps equipment suppliers and differentiated vendors, and that concentrated ETFs and momentum stocks can outperform in the short term, but bring higher volatility.
And where they diverged?
Debate centers on whether current ETF outperformance argues for a strategic shift away from passive benchmarks, or whether it's temporary. SPIVA research was cited. Historically, many active strategies underperform net of fees over long horizons, so there's healthy skepticism. There's also disagreement on earnings reactions like Netflix. Is that rotation or profit-taking? And within semiconductors, the mix between memory cyclicality and GPU secular demand sparks varied views.
I mean, when you step back and look at this, the sensible takeaway for most listeners is nuance. Don't overgeneralize from short-term winners.
Right. For long-term diversified investors, the guidance was reassessment, not wholesale change. Concentration raises short-term tracking error, so dollar-cost averaging and diversification still make sense. For active managers and allocators, the environment rewards high conviction and event monitoring, but with SPIVA-era caveats about fees and persistence.
And for momentum or tactical traders, the regime favors identifying concentrated winners and managing stop losses and position sizing tightly.
Income and conservative investors should be mindful of event-driven volatility from corporate filings and platform issues. Quality metrics, cash flows, governance, balance sheets are more important than chasing short-term outperformance.
So, what are the practical strategic considerations going forward?
5 key points. 1. Size leadership exposures consciously and test portfolios for sensitivity to repricing. 2. Differentiate within sectors. Break semiconductor allocations into memory, GPUs, and fab equipment, and so on. 3. Treat ETF outperformance as a signal, not an automatic reason to change benchmarks. Analyze factor composition and concentration. 4. Monitor event windows closely. Earnings, 8Ks, product launches like Broadcom's PQC solution. 5. Keep risk controls front and center. Hedging, position sizing, and liquidity checks matter more in elevated dispersion.
Right. And to repeat an important point, this is analysis for information. We're not recommending anyone buy, sell, or hold anything. Analysts note market sentiment and metrics. Decisions should match individual circumstances. And, if needed, a professional advisor.
Exactly. The data suggests the market in 2026 has been driven more by concentrated winners and company-specific outcomes than broad, steady leadership. That creates both opportunities and pitfalls. Concentrated ETFs and individual stocks have produced outsized returns, but the same dynamics can cause sharp reversals.
So, yeah, exciting and nerve-wracking at the same time.
Right. To wrap up, here are our clear takeaways. First, leadership concentration is real and materially affects returns. Second, differentiate sector allocations into structural themes instead of treating them as monoliths. Third, analyze ETF composition and persistence before making benchmark changes. Fourth, active event monitoring is critical in this regime. And finally, stick to disciplined risk controls, position sizing, liquidity checks, and hedging where appropriate.
Those are excellent. Quick reactions, 3 short ones to end. Watch the chips. Earnings still surprise. Size matters.
Thanks for listening to Alpha Recap. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.